Every time a Visa card taps a terminal, several companies may earn money. The surprising one is Visa, because Visa usually did not lend the customer a dollar, open the customer's account, or sell anything in the store. Yet in fiscal 2025, the company generated exactly $40 billion of net revenue and $20.1 billion of net income. That makes Visa look less like a bank and more like a toll road for money. But the toll road is almost invisible. A customer sees a card, a merchant sees a payment, and both may assume Visa moved cash directly from one to the other. What actually moves first is information. Imagine buying a $70 pair of shoes. The merchant sends the transaction through its payment processor to an acquiring bank. A message travels across VisaNet to the bank that issued your card. That issuer checks the account, the available funds and its fraud rules, then sends back an approval or decline. Later, clearing confirms what everyone owes, and settlement moves value between the financial institutions. Visa sits in the middle of that conversation. The issuing bank carries the ordinary risk that a credit card customer may not repay. The merchant carries the risk of stocking the shoes. The acquiring side manages the merchant relationship. Visa operates the network, rules, brand, security tools, and processing infrastructure that lets strangers trust the transaction in seconds. Scale turns tiny charges into extraordinary numbers. Visa reported $14.2 trillion of payments volume in fiscal 2025. It processed 257.5 billion transactions, roughly 706 million every day. Nearly 5 billion Visa credentials could be used at more than 175 million merchant locations. But Visa does not simply take the entire fee a merchant pays. That fee is divided among several participants. Interchange generally flows to the issuing bank. The acquirer and processor take their portions. Visa says it generally does not receive interchange reimbursement fees. Its own revenue comes from services tied to payment volume, transaction processing, cross-border activity, and a growing collection of other services. That distinction is the first key to the model. Visa can benefit when spending rises without funding the purchase itself. It can benefit when transaction counts rise even if the average purchase is small. And when the same card crosses a border, the economics can become more attractive again. The network also compounds. Consumers prefer a card accepted almost everywhere. Merchants prefer the card already carried by billions of consumers. Banks prefer a network that merchants recognize and customers request. Every new participant makes the system more useful to the others. This did not begin as a perfectly designed global machine. It began as an expensive banking experiment that mailed credit cards to people who had not asked for them. To understand how Visa became a toll road, we have to go back to the chaos that created the network. In 1958, Bank of America launched BankAmericard in Fresno, California. Instead of waiting for customers to apply one by one, the bank distributed cards at enormous scale. The launch created fraud, unpaid balances, and operational problems. But it also attacked the hardest problem in payments, building both sides of a market at the same time. A card is useless if few merchants accept it. A merchant has little reason to accept it if few customers carry it. Bank of America could recruit customers and merchants across its California footprint, absorb the early losses, and prove that a general-purpose card could work beyond one department store or fuel chain. The bigger opportunity was licensing. Banks outside California wanted the product, but banking rules and local relationships made a single national issuer impractical. BankAmericard became a system used by many financial institutions. Those institutions competed for customers while cooperating on shared standards. That cooperation mattered more than the plastic. A payment network needs common rules for authorization, disputes, fraud, clearing, settlement, and brand acceptance. It must persuade an issuing bank that a distant merchant's transaction can be trusted, and persuade the merchant that payment will arrive from a bank it may never have dealt with. In the 1970s, the participating programs were reorganized into bank-owned associations. In 1976, the international network adopted a single name, Visa. The name could travel more easily across languages and borders than BankAmericard. The blue, white, and gold mark became a compact promise that the same rules would work in another city or another country. For decades, Visa's ownership was spread across the financial institutions that used it. Then the structure changed. Visa consolidated most of its regional operations into Visa Inc. and completed a major public offering in 2008. The network had evolved from one bank's risky card experiment into an independent, public company selling infrastructure back to thousands of financial institutions. The transformation created a powerful position. Visa did not have to defeat every bank, banks became clients. It did not have to own every merchant relationship, acquirers and processors connected merchants. It did not have to persuade every consumer directly, issuers put Visa credentials into wallets. Visa concentrated on making the shared network reliable, accepted, and difficult to replace. The result is a two-sided network with several reinforcing loops. More issuing banks create more credentials. More credentials attract more merchants. More merchant acceptance makes the credential more valuable. Higher volume funds better fraud systems, tokenization, and uptime, which make the network easier for banks and merchants to trust. But scale is not free. Large banks, fintechs, merchants, and governments know how valuable their traffic is. Visa pays enormous client incentives to win and retain volume. Regulators scrutinize its rules, rivals compete on price and routing. The network must continually spend to keep participants inside the loop. That is why the $40 billion headline is not simply a percentage skimmed from $14 trillion. Visa's income statement contains 4 different revenue engines, and one giant subtraction. Following those lines reveals exactly how the toll booth charges. Visa's fiscal 2025 filing shows 4 gross revenue streams. The largest was data processing revenue at almost $20 billion. This is the machinery of authorization, clearing, settlement, network access, and related processing. More transactions moving through VisaNet generally create more opportunities to earn this revenue. The second engine was service revenue at $17.5 billion. Service revenue is primarily tied to the payment volume carried on Visa-branded products. When consumers and businesses spend more, this line can grow even if the number of physical cards barely changes. The third engine was international transaction revenue at $14.2 billion. This is why a purchase abroad matters differently from a purchase at home. Visa earns from cross-border activity and certain currency conversion services. Travel, international e-commerce, and commerce between markets can therefore produce richer economics than purely domestic spending. The fourth engine, other revenue, contributed just over $4 billion. It includes value-added services, licensing, account holder services, and other products. Visa increasingly sells fraud tools, risk analysis, consulting, authentication, and money movement capabilities around the core network. Add those 4 lines and the total is more than $55 billion. But Visa did not report $55 billion of net revenue. It reported $40 billion because one enormous line moves in the opposite direction: $15.8 billion of client incentives. Those incentives are discounts, rebates, and payments used to secure or grow relationships with financial institutions, merchants, fintechs, and other partners. They expose an important truth. Visa's network effect creates bargaining power, but its largest clients also have bargaining power. A global bank can steer billions of transactions. Winning that traffic may require a long contract and a very large economic concession. After incentives, Visa still retained $40 billion of net revenue. Its GAAP net income was $20.1 billion. That level of profitability is possible because software and network infrastructure behave differently from manufacturing. Building secure global systems is expensive, but processing the next transaction does not require building another factory or stocking another product. The model also diversifies the unit of growth. Rising purchase values help service revenue. Rising transaction counts help processing. International travel and e-commerce help cross-border revenue. New security, consulting, and money movement products help other revenue. Visa can earn more because people spend more, tap more often, travel more, or buy more services around the transaction. And the company can do this without being the consumer's lender. If a credit card customer defaults, the issuing bank ordinarily bears that credit exposure. Visa faces operational, legal, cyber, settlement, and reputational risks, but its core economics are not built on collecting interest from a revolving balance. That is the beauty of the toll road analogy, and also its limit. A private road becomes less valuable if traffic finds another route. Account-to-account transfers, domestic debit networks, rival card systems, wallets, real-time payment rails, stablecoins, and regulation all promise alternative routes. The final question is whether Visa's network is merely efficient or so dominant that competition cannot get around it. Visa's greatest advantage is not the card. A phone can replace the plastic. A watch can replace the phone. A bank can issue a new credential in seconds. The durable asset is the network of institutions, merchant connections, rules, security systems, and consumer trust behind the logo. That network is difficult to challenge because a rival must be useful on day one. A cheaper payment rail still needs banks to connect, merchants to accept it, consumers to choose it, fraud systems to protect it, and regulators to permit it. Visa already operates across more than 200 countries and territories with nearly 14,500 financial institution clients. Visa reinforces that position by moving beyond the traditional card. Tokenization can replace sensitive card numbers with safer digital credentials. Visa Direct supports money movement to eligible cards and accounts. Risk and identity tools help clients score transactions. The company is also experimenting with stablecoin settlement and payment systems for AI-driven commerce. But the same scale that creates the Moat attracts legal pressure. In September 2024, the United States Justice Department sued Visa over debit-network competition. The government alleges that more than 60% of U.S. debit volume runs across Visa's network and that Visa uses contracts, incentives, and other tactics to suppress alternative routes. It says Visa earns more than $7 billion a year from U.S. debit processing. Those are allegations in an active case and Visa contests them. The distinction matters. A court has not simply declared the government's full story true, but the dispute exposes the central tension of payment networks. The features that make a network convenient. One standard, broad acceptance, deep integration, and predictable routing, can also make switching difficult. Merchants want lower costs, banks want incentives and reliable service. Governments want resilience and competition. Consumers mostly want the payment to work. Visa must satisfy all four while defending margins that make its business look extraordinarily efficient. The threats are real. Real-time account-to-account systems can move money without a traditional card message. Large wallets can place their own interface between the customer and the network. Stablecoins can settle value on different infrastructure. Regulators can change routing rules or fee economics. Cyber failures could damage trust in an instant. Yet alternatives face the same cold start problem BankAmericard faced in 1958. A payment method needs users and acceptance at the same moment. Visa spent decades building both. Even when the card disappears into a phone, the transaction may still travel across Visa's rails. That is how Visa built a $40 billion toll booth. It separated the profitable coordination layer from much of the ordinary lending risk. Banks supply accounts and credit, merchants supply goods. Consumers supply spending. Visa supplies the common language connecting them, then charges in several ways as volume, transaction count, and international movement grow. The lasting lesson is not that every company should become a payment network. It is that the most valuable position in a market may belong to the business that makes everyone else compatible. Own the standard, reduce friction, earn trust, and each new participant can strengthen the system for every participant already inside it. The danger is that the same flywheel can become so powerful that customers, competitors, and governments start asking whether the toll road still has a genuine alternative.